Hi everyone, it's Miguel again with a final installment in my YouTube series, 10 Common Wall Street Misconceptions. And the misconception we'll be addressing today is that businesses are still safe without an economic moat. What an economic moat is it's basically whatever's competitive that allows for businesses to be competitive. It's sort of like a moat that they carve out around a castle or around a business, but that's the metaphor that Warren Buffett uses. He says that if the business is sort of like a proverbial castle, that there needs to be some kind of hypothetical moat or something competitive that other firms cannot replicate if they attempt to compete in the business's space. And I'm going to identify four of the major forms of economic moats that is taken from a 200 course by Morningstar Online, and I'll be sure to include the links that show exactly where you can read more about it, as well as choosing to sign up for this online course to learn about stock investing. I personally did it, and I think that I learned a lot from it. So if you're really trying to understand finance, I think that that would be a great start for a lot of people. But the first one is the low-cost provider. A business is competitive if they can keep their costs lower than any other competitor who could come into their space. An example of that would be Walmart. Walmart actually puts into their contracts with supply chains and with wholesalers that they are not allowed to offer a price to other people that's lower than the Walmart price. And that's why they have the low price guarantee, because if you ever bring in any merchandise that is lower than what Walmart is providing for it, then they can go right back to the wholesaler who makes this product or distributes it and be like, hey, wait a second, like, why were they given a lower price? And then can go after them that way. So usually in order to be a low-cost provider, you need to be working with some kind of an economy of scale, or basically what that means is that the more that you grow the business, that the cheaper your costs go down, and the only way you can sustain that is if you're always the biggest player. And a lot of corporations really aren't able to carve out a competitive space by being the low-cost provider, so they'll have to turn to some other form of economic moat. The second one is high switching costs. Firms can protect their profits by making it impossible to switch to one of their competitors. An example would be Green Mountain Coffee Roasters with their Keurigs. On some of the newer models, they actually have a sensor that they put into the Keurig that ensures that you only buy K-Cups. And now K-Cups will be expensive on their own. The theory is that as long as... One second. As long as you think that it's too high of a switching cost to go and buy some other kind of coffee maker, then they're going to be able to keep you and retain you in their brand. Secondly, you could think of like AT&T or Comcast, that if they require you to pay some kind of cancellation fee, or you're going to have to pay to set up another kind of cable or internet, that by having these high switching costs, then they make it harder for you to go and convert over to a competitor. Another example would be that with gyms. If a gym decides that they're going to hit you with a $200 cancellation fee, well then of course you're going to stick with the gym, because it's going to be more expensive theoretically to leave the gym than to just stay with it. So high switching costs is one of the economic moats alongside low cost provider, but the third one is what's referred to as intangible assets. Now, intangible assets are things that are like branding power, patents, trademarks, anything that is some sort of asset that doesn't allow for other people to replace it because of the fact that you have some kind of goodwill that's locked in that another firm couldn't take. An example would be Rolex. Another company can't call their watch a Rolex watch because that'd be an infringement of the Rolex brand. But the reason why Rolex is able to make so much money is because they actually restrict the amount of watches that they produce each month to create an artificial scarcity in the marketplace. But because everybody knows that there's only so many Rolexes to go around, they're able to benefit off of their intangible assets because Rolex carries this much bigger value because of the fact that they've built their brand around scarcity. Another example would be Schweitzer Moat International. They're a firm that actually designed low ignition propensity paper, also known as lip paper. And what lip paper did was that it basically went out by itself as long as there wasn't any kind of oxygen or inhalation that was allowing for the cigarettes to continue to burn. In a lot of countries, they actually made low ignition propensity paper a legal requirement because they thought that they were safer and they would prevent houses from breaking down. But for a while, Schweitzer Moat actually had a legislated monopoly. They were the only company that was allowed to produce low ignition propensity paper, and they had various patents that protected that. But because there are so many countries where lip paper was required that still wanted to produce cigarettes, that it forced a lot of cigarette brands to have to do work with Schweitzer Moat because they were the only ones that were allowed to print the cigarette paper that was legally required in a multitude of countries. Until recently, there was a court case that basically ruled that they did have a legislated monopoly, so they had to give up the ability for certain people to compete. But that's a clear example of how an intangible asset like a patent or a trademark will allow for you to benefit significantly. Intangible assets also play a factor in drug companies, in technology. I know that I personally invested in a company known as 3D Systems that was a 3D printing company that had a few hundred patents, and I thought that they were going to be able to secure that over the long term. Although there was news that came out that showed that a lot of their patents were set to expire in 2014 and 2015, that caused a lot of investors to sell off and a lot of their demand to drop because there was other players who came into the marketplace who were infringing on their space. So when a company carves out the economic moat of intangible assets, you want to make sure that it's something that they have a long patent life on or a long life to their trademark, and you want to make sure that you are privy of when a patent might expire, because that allows for other firms to come in and replicate what they're doing. Another example would be Shire Pharmaceuticals. They're the ones who make Adderall, and for a while they were the only company that was allowed to create Adderall until it expired, their patent expired, and that allowed for other people to come in and produce the generic, which saw a drop in their profits. But for a while they were making a stupid amount of money and nobody was allowed to compete with them. The final one that is talked about in this Morningstar course is the networking effect. And the networking effect is basically a company that is able to produce such a solid network into what they're doing that other people can't replicate their network. The example that they use is eBay. eBay has such a market of buyers and sellers that other auctioning corporations really can't compete with the network that eBay has built. So even though eBay might not make a lot of money on face from the trading that's going on, they're still going to be profitable because nobody's ever really going to be able to compete with them. Another example would be Google, that Google has such a strong network of advertisers who choose to advertise on Google as opposed to other places, that their Google AdSense program is responsible for about 80% of their revenue because they've built such a solid network with corporations who advertise during searches. Finally, Facebook's another great example, that Facebook has, I think, like 1 billion or 2 billion different people who have Facebooks around the world, that nobody has been able to replicate the kind of network that Facebook has. Sure, there might be Twitter or Instagram, but they just really don't compare in terms of the number of people who are using that as social media. So when you're looking at a business, you want to make sure that they carve out something that's competitive. And the way you can do that is by asking, are they a low-cost provider? Do they have high switching costs? Do they have valuable intangible assets? And do they have a network that other people can't replicate? And if you don't have a sufficient answer for any of those questions, then you might need to seriously reconsider where you're putting your money, or at least watch it a lot more closely to ensure that you aren't going to be investing in a company that a competitor is going to come in next quarter and steal all the profits. So thank you again for listening to this series, and I hope that you all tune into the next series that I'm going to be creating, which is the 5 W's of finance: who, what, where, when, and why. And I'll break down how you can analyze a company based off of all of those different levels of analysis and the proper tools that you can utilize for each one. Thanks again, and hope you all start investing and that you also make a lot of money. Thank you.